Hello, and welcome back to Fluxfolio Finance. It is March 2026, and the world is no longer drifting toward crisis. It is stepping directly into it. For years, analysts spoke in quiet tones about a shadow war between the West and Iran, a conflict fought through proxies, sanctions, and signals. But on February 28th, that shadow disappeared. What replaced it was the blinding flash of open war. Today, we break it all down. The 2026 Iran War. What is unfolding on the ground, how it is choking the global economy, and the three scenarios that could define what comes next. And if you've been following this channel through our breakdown of global debt fractures, including the recent United States downgrade, or the fragile geopolitical balancing in the Gulf, you already know this moment didn't come out of nowhere. This was building, and now it has arrived. Let's begin where it all started. On the morning of February 28, 2026, the United States and Israel launched what they called Operation Epic Fury, known in Tel Aviv as Operation Roaring Lion. This was not a limited strike. It was not symbolic. According to United States officials, the scale and intensity were roughly double that of the shock and awe campaign in Iraq back in 2003. The objectives were precise and absolute: to permanently dismantle Iran's nuclear infrastructure, sites like Natanz and Isfahan, to eliminate its ballistic missile capabilities, and to neutralize its naval presence in the Persian Gulf. But what stunned the world happened within the first hours: a decapitation strike. Iran's supreme leader, Ali Khamenei, was assassinated. The shockwave was immediate. Mujtaba Khamenei was quickly named successor, but internally, Iran's command structure entered what analysts describe as controlled chaos. And then came the retaliation. Iran activated Operation True Promise 4. Hundreds of drones, ballistic missiles, not just toward Israel, but toward United States bases across Qatar, Bahrain, Kuwait, and the United Arab Emirates. And for the first time, major civilian and economic symbols became targets. Dubai International Airport, the Burj Al Arab. Tourism stopped. Aviation froze. The Gulf went silent. But the real shock wasn't just military. It was economic. Because this war didn't just hit cities, it hit the artery of the global system. The Strait of Hormuz, a narrow 21-mile stretch of water through which roughly 20% of the world's oil flows and nearly 1/5 of global liquefied natural gas trade. Within days of the strikes, Iran moved to shut it down. And just like that, the world's worst energy nightmare became real. Shipping traffic collapsed, down more than 70% almost immediately, before approaching near zero. More than 150 oil tankers sat stranded outside the danger zone. Shipping giants like Maersk and Hapag-Lloyd suspended operations entirely. Then came the price shock. Oil, which was trading around $73 per barrel before the war, surged past $100, then climbed further, peaking near $126 per barrel. For a global economy already fragile, burdened by debt, inflation, and slowing growth, this wasn't just a spike. It was a stagflationary shock. And nowhere felt it more than Europe. Up to 14% of Europe's liquefied natural gas comes from Qatar, through that same strait. But after drone strikes hit Qatari gas facilities, Qatar Energy declared force majeure. Within a week, natural gas prices in Europe nearly doubled, and suddenly, a region just beginning to recover was staring at recession again. And as always, when the cannons fire, capital moves. Global markets reacted instantly. On March 2nd, the Dow Jones dropped over 400 points. Across Asia and Europe, indices fell between 1% and 5% as investors rushed to reprice risk. energy costs, supply chains, geopolitical escalation. But while equities fell, safe havens surged. Gold soared, testing levels near $5,400 per ounce, as both central banks and private capital searched for something outside the system. The United States dollar strengthened sharply, because in this crisis, the United States holds a paradoxical advantage. It is no longer just a consumer of energy. It is a net exporter, which makes the dollar, once again, a temporary shelter in the storm. But that strength comes with consequences. For emerging markets, especially those dependent on oil imports, the combination is brutal. Higher oil prices, a stronger dollar. Together they create crushing currency pressure. Central banks across the world now face an impossible choice: delay rate cuts, or even raise rates again, just to contain imported inflation. And just like that, the global easing cycle stalls. So the question becomes inevitable. Where does this go from here? Based on current intelligence, financial models, and strategic analysis, three paths are emerging. The first is the short-lived escalation. This is the scenario that policymakers in Washington are betting on. President Trump has suggested the campaign could conclude within 4 weeks. In this outcome, United States and Israeli forces degrade Iran's military capabilities rapidly, forcing the new leadership in Tehran into negotiations, possibly even a controlled political transition. If that happens quickly, markets may stabilize. Oil could retreat back toward the $70 to $85 range by year-end. The system bends, but doesn't break. The second path is far more dangerous. A stagnant quagmire. Under United States law, military operations without formal congressional approval face a time constraint, roughly 60 to 90 days under the War Powers Resolution. If Iran proves more resilient, if retaliation continues, this war stretches. And in that stretch, risk becomes permanent. The Strait of Hormuz remains unstable. Insurance costs remain elevated. Oil prices stay above $100. This isn't just volatility anymore. This becomes recession. Global growth contracts. Political pressure builds, especially in the United States as elections approach. The war fades from headlines, but embeds itself into the economy. And then there is the third scenario, the one markets don't price until it's too late. A regional inferno. If the conflict spreads, if Iran strikes directly at oil infrastructure in Saudi Arabia, the United Arab Emirates, or Kuwait, then this is no longer a regional war. It becomes a systemic collapse. Brent crude could surge past $130, even $150 per barrel. At those levels, economies don't adjust. They break. Energy rationing begins. Businesses fail. Financial systems crack. And suddenly, we are no longer talking about inflation or recession. We are talking about a crisis on the scale of 2008, or worse. As of March 10th, United States officials claim the mission is nearing completion, that Iran's navy, its leadership, have been effectively neutralized. But the Islamic Revolutionary Guard Corps tells a different story. They say they will decide when this war ends. And in the meantime, the world is watching two things at the same time: the battlefield and the petrol pump. Because in this war, oil is not just a commodity. It is the transmission mechanism, the signal, the trigger. And whether this becomes a short shock or the beginning of a new global era will be decided not over years, but over the next 2 weeks. Thank you for joining us on this deep dive. If you found this breakdown valuable, consider subscribing, because in times like these, clarity is not optional. It is survival. Stay sharp, stay informed, and I'll see you in the next episode. Goodbye.